Hello everyone. Today we are going to go through a certain topic, provision for depreciation of non-current asset. And this time I'm going to take you through some slides so that you understand and you'll be able to do some question on past papers. So what is a depreciation? Is actually the estimate loss of value of non-current asset from any over the period of its useful life. As you know, assets lose value because of different reasons. So let us look at the cause of depreciation. The first one is wear and tear. So physical deterioration. As assets are being used, they lose their value. This is the cause of assets to wear out. So an asset is worn out because it has been used for a long time. Then there's passage of time. This arises when a fixed asset has a fixed life of a certain number of years. For example, you're going to stay with an asset for 5 years, so you have to be depreciated within that 5 year. Then there is depletion. This arises in connection with fixed assets such as land, well, and mine. This is, for example, a land which in which they have extracted some minerals. Definitely, the land has lost its value. It is no longer the same. It has been depleted. Obsolescence. It is when an asset is no longer compatible with the current technology. For example, there are better products coming in, so computers may not have the same, cannot for example accommodate the same software as before, so they will lose value. All right, so very fast now let's look at the reason for providing depreciation. As you know, there are two concepts which are being applied when you are depreciating an current asset. There is a prudence principle as well as matching principle. Okay, so the prudent principle is it says that you have to avoid to overstate profit, all right, or understate loss, and also should not overstate non-current asset. So you know, depreciation is a non-current. I mean, when you are depreciating non-current asset, you are trying to avoid overstating non-current asset because they have lost value. So you show the actual amount or actual value of that asset. At the same time, provision for depreciation is an expense. So if you overlook it, you're also going to overstate profit. So both of these apply prudence principle. And then we are actually putting the expense in the same financial year. It means we are charging the expense or make sure that expenses are recognized and recorded in the same financial year. This is matching principle, where you actually match the actual expense of the year is the one which is charged to the income statement, right? Now, let's see now how to calculate depreciation. So to calculate depreciation, look at the straight line method, which is straight line method of depreciation. It uses the same amount of depreciation each year. So it is used where each year is expected benefit equally from the use of the asset, e.g. building. So you know, straight line, to use a straight line method, you take the cost minus residual value divided by number of years the asset has been or remain in the business. Sometimes you can also use a certain percentage when they say, for example, 20% on cost, and that's it. That will be the depreciation, right? So reducing balance method it uses the same percentage rate of depreciation each year, but it's calculated on the net book value at the end of the year. So this one you keep on reducing because it's calculated on the net book value, right? So it is used where the greater benefit from the use of the asset will be gained in the early year of life, like a computer or equipment or a motor vehicle will gain more benefit from them when they are new than when they are old. So in that case, the depreciation, when they are wearing out, the depreciation also will keep on decreasing, right? Revaluation method is where you revalue especially the small tools or tools of low value, loose tools. So this is just to look at the value at the beginning and at the end, and you subtract. So the asset is valued at the end of each year, and the difference between the opening and the closing value is the depreciation for the year. So it is used where it is impractical or difficult to maintain detailed record for the assets. So these are small tools which are of less value, where you just value them by looking at the cost and the value at the end. Right. Now, moving on to recording now depreciation. When recording depreciation, whether using revaluation or straight line or reducing balance method, you have to understand that depreciation is an expense which will be transferred to the income statement. So with debit income statement, I told you to debit income statement is to transfer this amount as an expense, right? Debit income statement, when the income statement is debited, it means the expenses are increasing, and when it is credited, the income is increasing. So we debit income statement and we credit provision for depreciation. So this account does not close. It keeps on showing the depreciation for the year as it accumulates, as we are going to see shortly in an example, right? So let's look at the example where you're using the straight line method. We have, for example, a vehicle. Remember, straight line method is where the depreciation remains the same throughout. So we have a financial year of ABC, which ends on 31st July. And on 1st August 2020, a motor vehicle was purchased for 10,000 and it will be used for 5 years and be sold as a scrap value of 2,000. We have to calculate the annual depreciation, the total depreciation on 31st July, the net book value on 31st July 2022, and the provision for depreciation account. We have to show also the extract of the income statement and the statement of financial position on 31st July 2022. Right, so calculating the annual depreciation, we'll simply take the cost minus residual value divided by number of years, as you can see here, and the answer that we are getting here is 1,600. So that is the annual depreciation. And the total depreciation, since we are using a straight line method and depreciation does not change, we just take 1 year depreciation times the number of years, because the depreciation will remain the same every year. So if we have 2 years, then that will be 3,200 up to 31st July 2022. And the net book value will be now 10,000 minus 3,200, which will equal to 6,800. This is the total depreciation now for all the 2 years, which we deduct from the cost to show the net book value. The net book value is very important because it's the one that shows in the statement of financial position. Now, if we have now to show the provision for depreciation account, like I say, we credit provision for depreciation and we debit income statement. Yeah, remember that our depreciation for the year is 1,600. So we have credited it and debited income statement. Then we show the balance carried down and the balance brought down. After showing the balance carried down, we add both sides and we show the balance brought down at the beginning of the next year. Please watch out on the debts. As we are depreciating our asset, we credited the provision for depreciation at the end of the year. And remember, our year started on 1st August 2020 and it is ending on 31st July 2021. So that's the same day we show the balance carried down and the balance brought down, right? Then we have at the end of the year again, on 31st January 2022, again we do the same process of transferring 1,600 in the income statement by creating provision for depreciation and debit income statement. Right, so then you show the balance carried down. The balance carried down will be for 2 years, 1,600 plus 1,600, which is 3,200. We add both sides and bring down the balance on 1st August 2022. Right, so the extract of the income statement, remember in the income statement we show the depreciation for the year, for that particular year only, not accumulated depreciation, but depreciation for the year. So here the depreciation for the year is 1,600 and the statement of financial position is showing now the total depreciation of the year, which is 3,200, and it will be subtracted from the cost to find the net book value, because this is the actual value of the asset at the end of the financial year. Right. Now let's move on to reducing balance method. We have another example here where the financial year ends the same question. It ends on 31st July. A motor vehicle which costs 10,000, but this time we are given a rate of depreciation of 20%. So again, we have to calculate to find the annual depreciation, the total depreciation, the net book value, and we show the provision for depreciation and extract of income statement and the statement of financial position. Right. So in this case, we are to calculate the depreciation is to fund 20% of the cost, which is 2,000. 20% of 10,000 is 2,000, and the net book value is 10,000 minus 2,000, which is 8,000. Then the next year, the depreciation will be calculated on the net book value of 8,000. So 8,000 times 20%, and then we calculate the book value by taking 8,000 minus 1,600, and so on and so on. Right? So since we are told to do it only for the second year, we are the total depreciation, of course, is the first depreciation of 2,000 and the second depreciation of 1,600, which will make 3,600. And the net book value, remember the cost is 10,000 minus the total depreciation to find the net book value. Right. So we are repeating the same process as we did when we were doing when you're using the straight line method to create provision for depreciation debit income statement. Then you show balance carried down and balance brought down. And the next second year, the depreciation has decreased from 2,000 to 1,600. And the 1,600 will be the one to be shown in the income statement. So we will credit it and debit income statement and show the balance carried down and balance brought down. As you can see, when you're recording the provision for depreciation using the reducing balance method, the depreciation keeps on decreasing. It was 2,000, then it's 1,600, and it will keep on decreasing because it's calculated on the net book value. Right. So the extract of the income statement is 1,600 as an expense in the provision for that in the income statement, which will be subtracted from the gross profit. Right. So gross profit less expenses, because this is the depreciation for the year. But in the statement of financial position, we show the total depreciation, which will be subtracted from the asset, and which will take, that will be now 10,000 minus 3,600, which is equal to 6,400. As you can see in the statement of financial position, you show the total depreciation and you subtract it from the cost. Right. So we have gone through a few slides. Now we should go through some past exam papers, because basically this is just the basic knowledge of depreciation. When you go to the question paper, the questions are a bit more complicated, as we can see, as we are going to see in the moment. Right, so let's look at this question here, number 17. Agi is a trader. She uses the following method of depreciation for different type of non-current asset. There is a straight line method 20%, reducing balance method 25%, and revaluation. So on 1st January, year 1, Agi purchased a small item of equipment costing a total of 2,400. Already being told that small item, it is an indication that it's likely to be a revaluation method, because that's the one which is used for small item. So it is 2,400 and fitting costing 8,000. So on 31st December, year 2, Ag estimated that the equipment was worth 70% of the original cost. Since they just estimated that it's going to be 70% of original cost, this is enough indication that the revaluation method has been used. Right? So let's look at if we use revaluation method, right, we are going to take 2,400 times 70 over 100. So if we take 70% of 2,400, we'll get 1,660. As they say, that could be the actually value of the asset. So which means they have not used any other percentage, just say 70% should be the value at the end of the year. So the statement of financial position shows the net book value equipment of 1,680. So which is exactly 70% of 2,400. All right. So and the fitting at 4,800. So let's see now which depreciation has been used for the fittings. So what do? It means we are now going to take the cost of 8,000 And we try with the straight line method of 20%, all right, which will give us 1,600. And since we are talking about year 2, they're talking about year 2, all right, so which means the total depreciation is 1,600 times 2, right? So 1,600 times 2 is 3,200. So what is the net book value? Net book value will be 8,000 minus 3,200. So if I take this 8,000 minus 3,200, I'm getting 4,800. So the 4,800 is the net book value for the second year. And that's what we have here, which means the answer is C. Actually, for equipment, they have used the revaluation method, and for fittings, they have used the straight line method. Right. Another question here, number 18. Okay, this question number 18, there is a disposal account, so we haven't yet done that. We are going to see that in part 2. So we are going to look at another question from another past paper. Here's another question. Beketere financial year ends on 31st December, and on 1st January 2015, she purchased the machine costing 18,000. Right? The machine cost how much? 18,000. And on 1st January 2015, purchased machine worth 18,000. The machine was depreciated by 15% per annum using the straight line method. So the machine was sold on 1st January 2019. So what was the net book value? What is the book value of the machine on the date of sale? Right. So if you look at the time the machine was purchased on 1st January 2015, and on from 1st January 2015 to 1st January 2019, there are 4 years. It's 4 years because it's 15, 16, 17, 18. Since this is a 1st January, we're not counting 2019. So 4 years, and the depreciation is a straight line, is equal instrument straight line. So which means the total depreciation is, the annual depreciation is 18,000 times 15 over 100, right? Which is 2,700. Then we multiply by 4 for 4 years. So the total depreciation is 10,800. Then we take away from the 18,000. So 18,000 minus 10,800. And the answer we get is 7,200. So this is the actual value, the net book value of the asset on 1st January 2019. Here's another question. Anis purchased a motor vehicle costing 23,000 on 1st August 2016. She decided to depreciate the motor vehicle using straight line, the installment method at 20% per annum. Depreciation on the motor vehicle of 4,600 was charged to the income statement to the year ended 31st July. So 1 year depreciation here is 4,600, right? So the 4,600 is being calculated by simply taking 23,000 times 20%, which will give you 4,600, which is the depreciation for the year. So now the question, how much was charged to the income statement for the year ended 31st July 2018? This was the depreciation for 2017, and we are asked to find the depreciation of 2018. So since we know that if we are using the straight line method, the depreciation will be the same. The depreciation for the year will always be 4,600. So even in 2018, the depreciation will still be 4,800. So the answer for this question is B. Right, this is another question. Why should a trader provide for depreciation of an current asset to match the cost against the revenue of the year, which benefits from the use of the asset? This is a proper matching concept, which is correct. And to provide a cash fund to enable the assets to be replaced at the end of the year. No, there's no way depreciation can provide you with funds. Then to recognize that most of non-current assets lose value with the passage of time. This is correct, because we have learned that one of the depreciation, the reason for depreciation is the cause of depreciation is passage of time. To spread the cost of the asset over its expected working life to avoid overstating profit. This is also very correct. So you are spreading the cost over the expected working life, so that you don't avoid overstating profit, because we say depreciation is what? Is an expense, right? So 1, 2, and 1, 3, and 4 is the answer. So the answer here is B. Right, we have another question, number 13. Equipment costing 20,000. Sorry, missed that one. Okay. Right, so equipment costing 20,000 was purchased on 1st January 2019. It has a useful working life of 5 years and a residual value of 3,000. Depreciation using the straight line method was included in the income statement for the year ended 31st December 2019. It was then found that reducing balance method of 30,000 per annum should have been used. Right? What was the effect on the profit for the year ended 31st December 2019? So they have used the straight line method instead of reducing balance method. Now, if the straight line method was used, it simply means that they have calculated the depreciation of they calculate the annual depreciation by taking 20,000 minus 3,000 divided by number of years, which is 5 years, right? So if we work out this, we find 20,000 minus 3,000 divided by 5. The answer I'm getting is 3,400. This is the depreciation which was actually put in the income statement, and yet they were supposed to use the reducing balance method of 30%. So when they are giving you 30%, you just apply to the cost straight away. So it means 20,000 times 30%. That was the first depreciation on the reducing balance method, right? So 20,000 times 30 over 100 is 6,000, right? So what do we conclude? They have charged less depreciation, 3,400 instead of 6,000. So if you look at the difference between 6,000 and 3,400, is 2,600. So the 2,600 profit was overstated because the expenses were less. So the answer is C. Right. So now let's look at a question on a structured paper, paper 2. This is October-November 21. Right. So Amelia opened a business on 1st April 2017. On that date, she made the following payment by bank transfer. So, and we have to complete the table by placing a tick to indicate whether each payment is a capital expenditure or revenue expenditure. Please be reminded that capital expenditure is actually the when an asset is purchased, all right, or else you are adding value to non-current asset. So you are buying a non-current asset or adding value to non-current asset. Please remember that there are costs which go with the non-current asset. These are installation cost and transportation cost, carriage cost, as well as legal cost. So remember to take note of that: installation cost, carriage cost, and legal cost, right? So non-current asset, when you are purchasing non-current asset like premises, this will be capital expenditure. It goes into the statement of financial position. While revenue expenditure are day-to-day expenses which go into the income statement, right? So premises obviously is capital expenditure. Office furniture is capital expenditure. Carriage on office furniture is also capital expenditure because, like I say, is a carriage cost. When you are buying furniture and you spend money to carry that furniture, it means all these will be together the total cost of the furniture, right? Stationery of small office equipment, obviously this is a revenue expenditure because it's just a day-to-day expense. And legal expenses on purchasing premises. So you purchase premises and you spend money on legal expenses, so it is a capital expenditure, right? Remember, legal cost, installation cost, and carriage cost. Computer equipment, it's a capital expenditure. Installation of computer equipment, capital expenditure. Ink cartridges, of course, it's an expense, so it's a revenue expenditure. But now let's look at the question where we are supposed now to show the depreciation. Amelia decided to depreciate her non-current asset using the reducing balance method. Premises 2%, office furniture 20%, and computer equipment 30%. Name the one other method of depreciation which Amelia could use. So this could be straight line or revaluation method. Yes. Straight line method or revaluation method. Yes. Those are the two types, the three types of depreciation I've learned. Now, prepare the following account for each of the year ended 31st March 2018 and 31st March 2019. Then balance the provision for depreciation of the computer equipment account and bring down the balance. Right. So the computer was purchased on 1st April 2017. That's the time they purchased the computer. So for the computer equipment account, we just have try the date here, which is April 1st, 2017, and the total, the detail will be back, and the cost of the equipment. Since we are saying that we have equipment here, which cost equipment here we have. Carriage on office furniture, premises equipment is 1,600, and the installation of computer equipment of 100, which means the total cost of the equipment is 1,700, not 1,600, right? So that means we debit the computer equipment 1,700 and we credit bank or cash, right? Now, at the end of the year now, since the year started on 1st October, on 1st April 2017, 1st April 2017, which means the year ended on 31st March 2018, right? And the other year started on 1st April 2018. It's very important that you take care of the date, and it will end on 31st March 2019, right? So 2019 here, that's the second year. That's when the second year ends. Now, if we are recording in the provision for depreciation, we are recording at the end of the year, meaning our year has ended on 31st March 2018. If you recall, when we were doing the slides in PowerPoint, we actually say that we have to depreciate the asset by crediting provision for depreciation and debit income statement, right? Now, look at the cost. The cost is 1,700, and the equipment depreciation is 30%. So we are going to calculate 30% of 1,700, right? So 1,700 times 30 over 100, which is 510. So 510 will credit in the provision for depreciation. Remember, the date is 31st March 2018. That is at the end of the year. March 31st in 2018. So we'll credit 510 here and debit income statement. Okay, then we balance off the account the same date in March 31st 2018. Please don't go for this shortcut of writing incomplete word. All right, and we have to show the balance carried down of 510, and we add both sides. We close for that year 510, 510, and the next day, which is April 1st 2018, right, we have a balance brought down of 510, right? So this is the situation for the first year. Now, as we are now going towards the second year, our second year ended on 31st March 2019. Again, we transfer to the income statement the depreciation for the year. Remember, our first depreciation is 510, and we are using reducing balance method. So the cost is 17,000. So is it 17,000 or 1,700? Sorry, 1,700, right? So 1,700 minus 510 to get the net book value, and we multiply the answer we get multiply by 30%. Okay, so and now the depreciation will be 357. All right, so 357 is the next year depreciation. Remember, how did you calculate that? We are using the reducing balance method. So we took 1,700 minus the depreciation of the year, and the answer we got, we multiply by 30%. Okay, and we got 357. So on the very same day, that is in March 31st 2019, there will be a balance carried down. This time around, the balance carried down will be 510 plus 357, which is 867, right? So the balance of 867 will be recorded, and we add both sides, 867, 867. This is the 510 plus 357, and we bring down the balance on the following day, that is April 1, the same year, 2019. There will be a balance brought down of 867. Right. So I just want to repeat something. What you have always to remember is that what goes in the income statement is the depreciation for the year. Right? As we are using reducing balance method, the depreciation will keep on reducing. Okay. If we had been asked to show the statement of financial position, we would take the cost of 1,700 minus the total depreciation of 867 to find the net book value, right? So these are a few of the questions on the provision for depreciation. We are going to take part 2. I hope you'll be able to follow me in the next video, where we are going to look at the disposal of non-current asset, where you're going to use disposal account. Thank you very much. I'm encouraging you to subscribe and to like, so that you can have more video, which I'm sure will be very helpful. Thank you. Bye.